Thank you. Thank you very much for inviting me on this talk. A little bit different. We're going to talk about banks. And we're going to talk about what banks need and what banks want to do with data mining. It's a fantastic opportunity because they need so much help. They're looking for fintech companies. They're looking for outside help. And why? Because banks, they are so busy on themselves. I mean, look at, for example, what happened in 2008. Big crisis, big problems. And you have a whole new regulation that comes to banks. And they have put their IT teams at work to solve this. So their IT teams are busy doing something else. Basel III, Dodd-Frank, MiFID regulation, fundamental review of the trading book, it's everywhere. All IT teams in the banks are doing this for the moment. So banks need help on other stuff like data mining. My talk will primarily be on risk management. Banks, they do data mining on credit scoring, looking who should get the money on a loan, yes or no. On portfolio allocation, we do that also, robo-advice. I will look primarily here in the area actually of risk management. To illustrate this, I'm a risk manager. I mean, I have gray hair. I mean, look at me, I'm dressed like a banker. In my world, everything, the glass is always half empty. So I have this rather depressing graph that is actually showing the evolution of the average bank's stock price during actually the since 1990. So that's a history of 25 years. And so you see, it's after all these years, the banks have on average made 3% per year. And this little spike is a Donald Trump effect. So banks actually, they love Donald Trump for whatever reason. But you'll see why. And so now and then there's a big crisis happening actually. And we can pinpoint the crisis very often to a lack of understanding, a lack of mathematics. So I think computers sometimes make us a bit arrogant with this graph going back to history as simple to show that history will make it more modest and we can learn some lessons actually on the models we make and the models we design actually for banks. And that's what I want to show you. Every time something gets wrong in a bank, politicians, they wake up and they do some regulations. For me, the message is very basic. In banks right now, if you come into the trading floor or risk department, the people that are there, they are called data scientists. Data scientists. But they're the same people that I encountered when I started to work at the bank 25 years ago. They were called actually econometrists. They were quants. Quants. They're mathematicians, computer scientists, PhDs. They are quants. So the same people, now they have a different title, but they're doing exactly the same job. So in the beginning, actually, in 1973, after the invention of the Black-Scholes model, so I'm going too fast there, the quants entered the trading room. Trading, actually, risk management, portfolio management actually was something which was not computerized. This changed. Then actually, in the year 2007, banks became a risk manager. Quants became a risk manager. And then, very lately, and that's my talk actually, the quants, they become data scientists. And that's actually creating a lot of opportunities for companies, for students, for everybody else in this particular domain. Every time, every big crash, these guys intervene. This ugly building actually is in Basel, it's in Switzerland. It's the head of the Bank of International Settlements. And they actually come up with all these complicated rules that banks need to take into account to sort out their problems, to clean up their mess. So Basel I, Basel II, Basel III was designed actually on one of these particular floors. Yeah. Let's start actually at the beginning, 1973 Black-Scholes model actually, 1983 actually, when I just entered the army actually, this is the first computer which was put on the desk. It's a big evolution we took actually the last 25 years. The focus was actually at that time on modeling. Let me talk to you a little bit what modeling is. It's still very important actually. Modeling is a unique occasion for everybody who likes mathematics and who's strong in computer design, computer modeling, to get involved. What is modeling? Basically, quants that enter the trading room, they're making models, they're trying to come up with a conceptual view how the stock market works. For example, you have a one-factor model where you believe that only the stock price explains everything. You can have a two-factor model where actually interest rates are also part of the game. You can have a three-factor model and so on. So that is mathematical thing. So this dimension is purely mathematical. These are purely writing partial differential equations describing how the world moves to a certain model. With assumptions. I want to emphasize with assumptions, because it's something we forget all the time. Computer scientists, they're on this dimension. They're the guys actually who built the model into C++, a computer program actually, and who roll it down to the trading system. The big popularity of Black-Scholes is here. It's a single factor model, and it's a closed form formula, so it's super fast. But it comes with assumptions. And we forget about the assumptions, that's where things go very wrong. If you have a formula with assumptions, and we all believe it's true, and the whole world believes the same formula, it's working great, till something very bad happens. And then actually, it all ends in tears. And it ended in tears. So the first model that blew up big time actually was actually the crisis in 1998, LTCM, big hedge fund in the States, roughly $25 billion. These were very, very smart people. So two of them were had actually won the Nobel Prize in economics. They had more than 400 years combined experience actually trading. They had their own money actually in the fund, yet their arrogance, they overbelieve in the models actually proved them wrong, and it stopped there. So when LTCM blew up actually, we had the regulators come in, and they said actually now we have Basel II. We're going to make a new regulation to avoid this thing taking place. That's the Basel III, Basel II, and the quant, the guy who designing these sophisticated models, now becomes the risk manager. He's moving to a different floor. He moves to the risk department actually, but it's the same people, same degrees, same knowledge, but they move to the risk department. Great. Now, putting a quant in the risk department is a little like putting the cat close to the milk, because instead of helping the bank, lowering the risk, they've created new monsters. They created like the CDOs. The CDOs, very complex products where loans are packaged and then sold to the public. So you have a lot of crap, which is actually put together, which gets a label of being single A, and is sold to the street. These models are very hard to value. This is like a multi-dimensional or multi-factor partial differential equation, actually, fed by a volatility for each credit, and you have a very big correlation matrix to control this. One guy found a solution, Mr. David Lee. He founded actually Gaussian Coppola, and then you could run things on Excel. Of course, if certain conditions were fulfilled. And when people start to make money with a certain formula, they believe the formula is correct. And of course, when the formula is correct, and the whole world believes it's correct, eventually it blows up big time. This is what happened in 2008, when Lehman Brothers crashed. We had a whole avalanche, actually, of unwinding of these trades, actually. And now, unfortunately, when you go to Google and you look, for example, the formula that killed Wall Street, you'll find, unfortunately, this Mr. Lee. Now, I think it's a scandal because he's the guy, he designed the formula, he warned against it. He said, do not use this, actually, because correlations are not constant. But, of course, people use the formula, made a lot of money, actually, and eventually lost a lot of money. So it's the same thing as actually blaming Einstein from the atom bomb. I mean, he invented the photoelectric effect, relativity theory, and nuclear physics, but it is not, he should not be responsible for that. Same thing here. The formula that killed Wall Street is a side effect of that. So there we are. Quant becomes a trader, creates a mess, Basel II. Quant becomes a risk manager, actually. Again, we have a mess, and now we have Basel III, who is actually going to help us to prevent the previous crisis happening again, but not the next crisis, because that's always the same thing that I can't do. So we're here now, somewhere here. Does the Lehman just happen, actually? And we now are in the area where quants become data scientists and where banks right now need a lot of people to help them. Yeah. So what they do, it's called a new paradigm, because actually they're looking at new informations. They have actually not only time series, they have Twitter feeds, social media. They all want to put this to use in their trading facilities and their portfolio management. Yeah? Some of them have been very popular tools. Already geographical networks, Neo4gs, for example, used a lot because it's allowing you to look at the world in a different setting. Eh? So we move away from a correlation matrix to something dynamic, where you can discuss between two traders actually how your book is looking like. This, for example, the DAX market, the German stock index. Some of them have discovered clustering. Clustering is very interesting because I'm looking for the Holy Grail. And now, what is the Holy Grail? The Holy Grail is actually people that actually trying to link equity risk with credit risk, bonds actually, and equity. So here, this graph, for example, is actually the share price, and this is the credit spread. So we're using clustering to find a relationship and to see, well, actually, I have some two kind of, I have a region where the stock price is very low and the stock is very high. So I'm going to have two little regressions there. So clustering is something that actually entered the banks in this particular domain. Now, capital structure arbitrage, it's a holy grail, but when it goes wrong, again, it goes very, very wrong. In 2005, every single hedge fund out there lost money. Because, well, they did the same thing. They were buying bonds on Chrysler, and they were selling shares. So basically, their belief was actually, if the company goes down, if the stock goes low, and actually, my bonds will go up. And if the bonds get bad, actually, probably the share price will be lower. So that's a hedge. So long bonds, short equity. Capital structure arbitrage with this regression. And again, by too much believing in the system, by ignoring actually any side effects, you go wrong. Why do you go wrong? Because on one single day, the rating agencies, they downgrade the bonds, d'OCDR, so your long positions, you lose money. And the next day, Kerkorian came in. It's a hedge fund guru, and he did a takeover bid on the shares, so your shares go up. So what you own is losing value, and what you sold short actually is going up. So it's completely against the rules, against your mathematical illusion. And again, an overbelief in assumptions is something we should watch out for. And now what's my problem? Again, I mean, I'm from my mouth only negativism sometimes, but this is summarizing it. We're coming from an area where actually the infrastructure was purely client-server. A hedge fund on average is spending, a small hedge fund has to spend at least roughly between $200 and $500 per year on IT, on computer systems. So we move on a client-server basis to cloud. Yeah. What we see is that the algorithms, they were very limited actually, but now we have an avalanche actually of all kinds of data mining, machine learning, deep learning algorithms. Yeah. But what's really worrying for me is the following. What I see is that before the big crisis actually, the quant scene, the number crunching, the computer science knowledge in banks was owned by PhDs, engineers, mathematicians, computer scientists. And now we see that the barriers to entry are getting so low that everybody can call himself a data scientist and find a job. But we should know that below, underneath every single model, there is mathematics. Underneath every single model, there are assumptions. So I'm not sure actually that these low barriers are actually going to be a blessing. So being a banker, or if you're in fintech, actually make sure that you in your selling proposition, make sure you really emphasize that what you do is actually correct. And I see so many crazy things. Well, thanks to these guys, I mean, I love these companies, I love the software, but of course the fact they're so cheap is actually allowing everybody to call themselves a self-profile, to open up a shop above a butcher shop, and to start actually a data science company. So that's the barriers to entry is sometimes maybe too low, unfortunately. An example in my world actually is the following. So sometimes in data science we talk about supervised learning, right? You have the training, you fit your model, and then you go to the world actually and you're going to test it. You're going to see if the predictive power, if it's good or bad. This is an example in my world, being ex-quant, where I have to sell my client an option. I have to sell me an exotic option. So same thing, we're going to calibrate it. So I take all the other options in the world, I take my model, I calibrate it, and I have a perfect fit. And I have different models. Same thing as you have different regression models, I have different pricing models. So here I have 7 actually pricing models, and they're perfectly calibrated. Yet, I can see that for a particular instrument, I have my lowest price and my highest price, there's a spread of 5%. That's a lot, because the bid-offer spread is 10 basis points, 0.10%. So the mistake you can make by simply, you have the idea, the fallacy of I have something which is perfectly calibrated, but I'm going to lose my shirt if I have to sell here and buy there. Because being a good trader, it's always the same rule. You have to buy low and sell high, and here actually it's the other way around if I make a mistake. So this is, again, the idea of buying a cheap software, not understanding it, you have a perfect calibration, you're going to do obviously the very wrong thing. Where can it go wrong? Actually, I see a lot of things going wrong because nobody's reading the manual anymore. So I'm having a model supervised learning. Do I have to normalize? Yes or no? Should I center my data? What about multicollinearity? Should I listen to that? People don't. They take the model, actually, they get the data in, and they're happy with the result. So you always have to think before that. I'm preaching, of course, I'm preaching to the wrong people because you're the experts, but I think you'll be very surprised if you enter a trading room what kind of mysteries you're going to see. This is an example of such a mystery. So I went to a bank for an assignment, and this is Bloomberg, right? And in banks, they're using a lot of technical analysis. Now, I don't believe in that. What is technical analysis? Well, it's looking at your screen. You're looking at, for example, the S&P 500. You're looking at the chart, the graph. And based on that, you're going to receive signals that will tell you to buy and sell the stock. These are called charts or graphs. And they have different names, different compositions, and so on. And the technical analysts will make a decision to say, actually, I'm going to buy or going to sell. So they came to me saying, well, build us a model where we enter all these graphs, and you can train it, actually, to make a prediction model about the stock market. Of course, all these graphs, they're very different, but they're all the same thing. So you have a gigantic multicollinearity in your data set, which actually doesn't lead to anything. So it's again thing, it starts at the core, the assumption actually are very wrong. Another thing is here that nobody reads the manual. Take, for example, if you go to Python or sklearn and you take the random forest classifier, well, it's very easy. It's 3 lines of code. You take your data, you define the random forest classifier, you do fits, and you predict. 3 lines of code, and you're a data scientist. Of course, but nobody's reading the manual, and there are a lot of actually extra parameters involved that have a particular meaning. How do when is my node pure? When should I stop building my nodes? When should I do pruning, yes or no? People actually simply, they don't want to know that, right? So 1, 2, 3, perhaps, and I'm a data scientist. So this is actually, read the manual is very important. Overfitting, of course, this goes very wrong. This is my closing remark. It's the robots. And with robots, I mean actually those fun little things actually when you log onto a website that tell you actually, please, sir, give us your money, and we'll take care of it. And so what is the, it is there to stay. It comes from the US. We're expecting by 2020, $8 trillion being invested in robo-advisors. So it's online investment banks that make an investment algorithm based on your risk profile. And the portfolio is most often, it's constructed with ETFs. So not with shares, but with exchange-traded funds. These are funds that are trading online. That probably you know as well. A lot of guys are using the Black-Litterman model, which is a model with assumptions. But now again, this model is flawed. Fisher Black, I mean, this is the Mr. Black from the Black-Scholes model. He's unfortunately passed away, but otherwise he would have certainly won the Nobel Prize. He warned from this formula, but people are ignoring it because it's pretty handy. And so if the whole world is now assigning $8 trillion to a formula which is flawed, then I'm very worried that actually if something happens in the market actually, that we start selling and we're all going to rush to the same door and we are going to have issues. So if you want to be successful, that's my closing remark actually, in selling software or providing solutions for banks actually, try to do something else actually than the other ones are doing, and make sure you confront your client or your counterparty or your project colleague actually about all the different assumptions. Now, some people saying actually, don't listen to this guy from Belgium. He has been a risk manager too long. It's only with him, the glass is always actually half empty. Well, you know what? This guy is telling the opposite. So this guy is in a nice suit, is telling that the perils of the ETF investing is overdone. But I'm not sure. If a banker is telling me not to worry, I think I should worry. So with this being said, actually, you can ask me as much questions you want. Maybe after the coffee, I stay here for the whole day. But it has been a pleasure to hear me. I've very much enjoyed my stay. Thank you very much.
I assume when you speak about half glass, you mean half glass of beer?
Exactly. Yeah, of course. I forgot to mention it actually.
Yeah. This is from Belgium. Any more advanced questions than mine? for the talk.
Hi. Well, I'm definitely not an expert. Thank you for interesting talk. And my question is, suppose that there will be an ideal situation where when everyone doing risk management or data science will be an actual expert and the right formula will be used and assumption will be taken into account in the long run. What do you expect? That will everyone earn profit all the time? How it will behave?
There is. I'm not the expert investing. The only when you look around is that a lot of old-style funds are closing down, and they're moving to new technologies. For example, we have actually Point72. We have Renaissance Capital, very successful. And they admit, actually, that when they're successful, it's only because they discover something, an arbitrage, an anomaly, and they jump on it. And because they jump on it, they close the gap. For example, if something is too expensive, and you start selling, actually, well, it becomes cheap again. It goes back to the norm. Now, how the world looks like, actually, everything is fairly priced. Well, it would be very boring, I guess, no? It's, yeah, so that does not exist. And now I think that all the measures the government is taking is solving the previous crisis, but not the next one. And the next crisis, I'm 100% sure, is liquidity. There have been so many rules about what banks can own, and banks can own nothing, that if these $8 trillion of automatic traders start to sell, well, to sell to whom? Not to the other ones, because we're both selling. And the only country, no, the main country where the regulator is really involved in this is in the UK. In the UK, you cannot, there's a lot of control about who starts this online investment bank. You need, so you have to show your algorithms, and that's in Europe, the only country I know that is doing this, actually. And that's a good sign. That's a good sign. Hedge funds. Yeah. Are they also restricted the rules? No, the hedge funds actually, because they don't target the retail money. I can open a hedge tomorrow. I can file for my application at the FCA, and I can start my own actually algorithmic trading platform like I want. There's no control in hedge funds. Europe has tried to do it. So Europe has created this platform called AFMD. So in Europe, or your fund is UCITS, then you can sell it to my mother and my father and my mother, or your fund is AFMD. That means what? That you have to file a report every single quarter about what you do, but that's it. But you can still, so there's controls are still not there on the level they should be.
I just wonder if the regular models lead to something that is expected in terms of many people behave the same way. Why fight it? Let's take advantage of it. I mean, if I should advise any bank, I would tell them, this is what everybody is doing. Let's take advantage of it.
Yes, but in 2007, a lot of funds were doing the same thing. Not hedge funds, normal, just they were having the same idea. And then suddenly we have an earthquake. We have actually, in France, a very small incident in France, a very small incident. BNP Paribas said actually in the beginning of August that there are 2 funds where we have problems paying out. That one little line told, manipulate, then one fund started to sell, yeah. And then the other, and then you have everybody runs to the front door and you have a crisis. So if I was to do the same thing, it's like the memlings following each other. Actually, it's not going to work.
And the question that I had in mind was, do you have any practical advice about how to approach hidden phenomena, finding hidden patterns? Because all the supervised learning and everything is after we know what to look for, but one step before then.
So for me, what's remarkable, I have, unfortunately, I don't have the rights to go inside a hedge fund. 2 things. Renaissance Capital, which is a fund which is making money This is Jimmy Simmons, field medal in mathematics. This is like a smart guy. They're hiring more people from the domain of algebra than people from statistics. You would think, well, if you work for a bank as a quant, that's statistics. These guys are using people that do algebra, graph theory, right? Because they're trying to look at the work in a different way. That's one way to make money. A second way, it's a very smart way, and maybe for the students, actually, you can go to kaggle.com to make some money, but actually go maybe on a sunny, I would say cold winter even, it doesn't exist over here, but go to numer.ai. Maybe somebody has done it already, numer.ai. Yeah? That's what? That's created actually by Renaissance. So it's a platform because they're running out of ideas. They're running out of ideas. Eh? That's your question. Are there any more ideas? I think they're running out of ideas. So they created a platform, numer.ai, where the hedge funds puts data, and you have to forecast. You have to forecast. And if you get good, you get a certain score. And the guys good in prediction, they buy a model. So they're running out of ideas, and they use them to kind of a peer system where they buy a model and you get a share of profits. So they're running out of ideas. They're using now a wider scope to deal with this. Okay. Thank you for the questions.